Hey, welcome everybody. It's Walter here. I just want to make sure that you can hear me okay and that the sound's coming through and that you see my charts up here. Does that look good? I see a couple of familiar folks here. Hi, Adinda. Welcome, Sue. Asim is here. Welcome, Asim. Peter is here and Pavel. Mark. Minaj. Welcome, Minaj. Matt Jazz. Eber. Christian. Hey, Christian. Trend Trader. Uh, Pep is here, and Mish, Milan, and Edward. B Winner, Adinda, of course, Viswanath, Carlos, Jani, Ray, Sandy, Milan. Welcome, everybody. Thanks so much for spending time here. You are here at the Naked Forex webinar. My name is Walter Peters, and I wrote the book Naked Forex. We're going to talk about the forgotten time frame today. We're also going to look at a couple of naked setups on that forgotten time frame. I'll show you some of the misconceptions about trading this time frame because there are plenty, and I'll explain at least two reasons. And if I feel like it and we have time, we'll get into three, but at least two reasons why you should strongly consider, if you are trading, you should strongly consider trading this time frame because there are multiple advantages to doing so. And they're not only just for the bottom line, but also for your development as a trader. So let's jump into it. So which pair would you like for me to use as an example when we get into today's topic, which is, of course, good day, Alexander. Welcome. The yen, says Carlos. Carlos would like to see the yen. We could probably do that. Any other requests? I actually thought someone would say the euro, but let's see here. All right. All right. So here is the yen, and here is the time frame that I'm talking about. This time frame is followed by institutions across the world. This is, of course, the weekly time frame. It's one of the reasons why if you hear advisors and people from banks talking about what they expect over the long term, what to happen, the reason why they're saying these things is because they're looking at the weekly charts. Now, one of the things you'll notice, just a quick glance across the weekly chart here, is that you will see the same patterns that you see on the 4-hour, the same patterns that you see on the daily, and these naked patterns. I've identified two of them here. Actually, here's another one. Here's a third one. Everyone see these? These are the same sorts of things that you're going to see. Here's another one. Actually, oh, well, that one doesn't qualify. Technically doesn't qualify. Here's another one. Do you see what I'm looking at here? So what is this first one right here? This one, I'm going to make the arrow a different color. I'll make it green. This green arrow points to what kind of setup here on the weekly US dollar yen chart. What is that? What formation am I looking at right here? Big shadow, you got it. That is it. So this is it's a special case engulfing candle. And this one, in this case, it's sort of a trendy big shadow because the market's it's come down from this high, made a new low over here. So that was our previous swing low. Or depending on, you could look at both of these, but the point is the market went lower than both of these lows, came back up, and then it printed a candle that engulfed 2 weeks. So 1 week had a higher high and a lower low than the last 2 weeks. Completely engulfed it. Really nice low close down here. It was the largest candle we've seen in the last 5 candles. So it qualifies as a big shadow. It triggered on the next week, pulled back a bit, and the following week, and then was off to the races. There was another one here, but this doesn't qualify because it's not this. This next one right here is not a big shadow because it's not the largest candle we've seen in the last 5. You also see that right here you have a bullish big shadow, and this triggered a little bit of a retracement before it hit these lows here and then fell again. You'll notice that right here you've got what we call a kangaroo tail. Some people get them confused with pin bars, but kangaroo tails are very specific types of pin bars that don't. A lot of people will take a trade and say it's a pin bar that I won't touch because it's not a kangaroo tail. And then what you see right here is, what's this one right here, guys? I'm going to put a blue arrow right here so you know which one I'm talking about. Which type of naked fork setup is this one? What have you got going on here? We know we had a big shadow, bearish big shadow. We had a bullish big shadow. We had a weekly kangaroo tail here. And Trend Trader nails it once again. That's a trendy kangaroo tail, right? So that, my friends, that is another signal. Now, here's why the weekly charts are so useful for traders. Here's why. I'm going to go over a couple of things, and I remember when it did this. You know, the yen actually did something kind of like this. This was in 2013. It did something like that, like in 2001, I believe. Let me go back and see if I remember. Yeah, this. The yen kind of did this back then, see? That's what it reminded me of when you see this sort of, megaphone type pattern, and it broke out and really took off from there. And recently the yen did the same thing, 2013. It did the same sort of thing here and then broke out and took off from that. And now we're off to the races. Really, really weak yen. But let me talk about the weekly charts and why it's so important. So first of all, the long-term positions that the banks have in mind, institutions and banks watch the weekly chart. Make no mistake about it. It's very critical. So if you see a critical support and resistance level on the weekly chart and it's been breached, don't think that the banks haven't noticed that. Don't think that the institutions aren't noticing that. And one that sort of really screams out on the chart is this 109.60 level, or 110, you could call it even. If you go to a line chart, you'll see that the market's repeatedly butted up against this level. Most recently, just not that long ago, right? In September, end of September, beginning of October. But most recently, it did a first touch trade right here, and this was back in 2008. So when it fell down through here, it came right back up, did a first touch, boom, and then it fell and it fell and it fell, kept going. Now we've recently busted across this level. We'll call it 110 for, a round number, just for the sake of, ease and defining it. But that's a pretty important level. And don't think that when the market goes past that level, it's really important, psychologically, that these really strong levels, they don't have to be round numbers, but they tend to be like 110, like yen pairs, like 110, 120, so forth. But beyond that, it sort of sets the tone for, what are we going to do with the yen? These institutions have to decide, what are we going to do with the yen? Well, we're going to buy these pairs. In other words, sell the yen and buy anything against the yen. Because the yen, let's face it, the yen could go to, it could go all the way to here. It could go all the way to 135. It could go all the way to 147. I know it sounds crazy, but it could definitely go there. And right now, if you're looking at this chart right now, you'd have to say that 125 is coming into focus, and 120 certainly, right? 120, 120, 50, around there certainly. So there are a couple of pretty aggressive targets. I think that it does need to rest. It does need to pull back. I don't know when that's going to happen. I know on the daily you can see that happening, sort of relaxation, but it may be gearing up for another move because, after all, it printed the pseudo kangaroo tail on the daily and it hasn't really gone anywhere. So it may just be resting now, and it's going to make another leap forward. But let's get back to the weekly chart. So why should you trade them? Number one, we know that the big boys follow. The big boys are watching. They're following the weekly charts, okay? So a lot of volume comes in based on breaking serious levels here. That's hard to dispute. But number two, you will rarely take a full loss. Let me explain what I mean by that. Actually, I can show you a trade I took that was a loser on the weekly chart. Sorry, when I say it's a loser, it didn't hit my profit target. It actually didn't lose money, and that's another thing about the weekly charts because it happens so slowly. Let me show you right here. It is the pound yen weekly chart, and forgive me if you've seen it before. I may have talked about it before, but there was a bullish big shadow in traffic, but because this bullish big shadow / belt had really taken out so many candles, I was keen to go long here, and I did, and it went up for a week or two, and then it came back down. It actually stopped me out at break even on this week's candle right here. And then it did a pseudo kangaroo tail, and it bounced back up. But what's nice about this is so on this one, let me just give you all my stop loss was right here. And this illustrates a very, very important thing about weekly chart trades that most people don't even think about this. So my stop loss was right here in this gray box, but I'm going to make it red because we know it means stop loss, right? And then my buy order was up above. I don't think I got in a retracement. I was thinking about it, but let's just say that we waited for the retracement to happen. I'm going to talk about retracement in just a moment. Now, a lot of people are going to look at this trade and they're going to go, you know what? You're crazy that you didn't make any money trading this and seeing it go up 500 pips or whatever. And, that's just silly. But my goal for this was not to make 500 pips because I want to show you something. Let's say that it went up. I'm not sure exactly how far it went in profit, but it went up almost 600 pips, roughly. So we'll say 590 pips. Now, remember, my stop loss was down here. That was about 580 pips, 570 pips, something like that. So it went about 1-to-1, a little bit better than that, and then came back and stopped me out. But my targets were way up here, so all I could really do once the market really ran up and then retraced at the end of the week is move my stop to break even, and then, of course, I was stopped out at break even right here. Now, that's okay with me. It's like the trade never happened. And here's the thing about taking profit early. If I had gone ahead and said, well, I'm up 400 pips, I might as well take some profit. Sure, it would have been nice in this trade, but what that means is I'm reducing my average winner to average loser, and that makes it easier for my system to lose money over the long run. So I'd much rather have this one either hit the target or hit break even and not take partial profit. Because if I had taken partial profit and then it raced off to my first target all the way up here, which is probably roughly where it is right now, I would have been really bummed, right? And I would have missed out on what I was looking for, which was to make more money than I was risking on that trade. But here's the thing that I want to illustrate here. Let's say that I didn't move my stop loss to break even. Let's say that I instead left it down here. And let's say that when I took this trade, let me show you on here. Fix it so you can see. Let's say I was in the trade this week, right? And then I said, you know what? I said, what if I just wait a bit and see if the market's going to hold here and go higher next week? And then what happened? Well, boom, it fell back down. Now at this stage, I see that the wick went to where my entry price was, but we closed a little bit higher. So I'm in roughly, in this case, I'm in roughly, 50 pips of profit, something like that. And then let's say, well, it's probably just coming down here to touch this and now it'll go higher, right? No, it went lower. Well, at that stage, I might say, you know what? I've given this trade a month and all it's really done is gone against me. And now after 4 weeks, I'm down 180 pips. I think I might pull the plug. And it's not a bad idea to pull the plug. And if I didn't pull the plug then, what I would have been likely to do is actually go like this. Put my stop loss around where these lows are, right here. So I actually moved it up so that I wouldn't take the full stop. Now that might not seem like a big deal. What that means is I'm saving 170 pips off my 570 pip stop, right? So instead of losing the full 570 pips, I only lose 400 pips. 400 out of 570. Does anyone know the math on that? Roughly? So if I'm only taking 400 out of my 570 stop, then I saved myself 0.3. So if I was risking 1%, and let's say 1% of my account is $2,000, right? So if I'm risking two grand on this trade, I actually only lose 1,400. So that's going to reduce my average loser, right? That's going to make it easier. I can have a lower win rate and still make money. So that's the important thing about this, because it did actually come down here, and you can see if I had waited, I would have been stopped out at my original stop. Or if I had moved my stop up, I would have been stopped out here. So that's one of the great advantages of trading the weekly charts, is that I have the opportunity to get out early and reduce my losers, reduce the average loser size. You normally wouldn't get that opportunity if you're trading the 5-minute charts, okay? So reduce average loser. Now, I want to talk about something that comes up a lot with the weekly charts, and this is the idea of, I can't do it, Walter, my trading account's too small. I can't have a 570 pip stop loss, right? How many people think about that? Does anyone think about that? Because here's the thing. That's not really a problem. There's no reason why all traders can't trade the weekly charts. Every trader should be able to trade the weekly charts. And here's why. If you have an account where you cannot set the lot sizes, so you are forced to risk $1 a trade, or £1 per trade, or 10 pounds per trade, or whatever it is, whatever the lot sizes are set to, then here's what you need to do. You need to pull out your money, right? If you're trading live. If you're not trading live, that's okay. But if you're trading live, pull that money out of the account and go find a broker who will allow you to set lot sizes. And they're out there. They're certainly most definitely out there. And if you don't know, you can always email me. I can give you some suggestions based on where in the world you are. Just email me, right? And I'll give you some suggestions. But basically, here's the thing, guys. There's no excuses. Everybody, if they want to trade, if you've tested the weekly charts, you should be able to trade them. Every single trader out there, it doesn't matter if you have a 200 euro account or a 200,000 euro account. Whatever size your account is, you can trade the weekly charts because you can set your lot size. And the advantage of this is great, because those traders who have to reduce, like if you have a system that you want to risk 2% on every trade, and because you can't set your lot sizes, you have to keep rounding down, and you end up risking 1.65% or 1.82% or whatever it is, because you can't set the lot sizes in your platform. That means that when those are winning trades, you win less. So you're actually losing money. You're actually losing money because your broker won't allow you to set custom lot sizes. And when you set custom lot sizes, you can precisely get the same risk on every trade, and it's a huge, huge advantage to your trading when you do that, okay? It's a huge advantage. Over the long haul, you will be expected to make many, if you're a profitable trader, over the long haul, you'll be able to expect to make much more if you set your lot sizes precisely. Okay, so we know that the big boys are watching the weekly charts. We know that you're probably going to have smaller losers. Instead of risking the full 2%, you're going to have a lot of trades that end up losing 1.3% or 1.6% or 1% and won't be the full 2% loss. And that's huge. And of course, that means you're going to reduce your average loser. Well, your average winner and your average loser, those go a long way to determining whether or not you're profitable, right? Along with the win rate. And if you can reduce the average size of your loss, that's going to help you out a lot. And you don't have to win as often if your losses are smaller. Okay, so now what else? What else is good about trading the weekly charts? Well, here's the thing that people forget. Like if you've got a job, if you're working, it's difficult for you to go to work for 8-9 hours a day and then come home and expect to scalp for 4 hours. I mean, that is a really tiring routine, right? So what you can do instead is set your weekly chart trades up and let them unfold in slow motion. You know, that's something that like if you look at what happens here on these, it's like watching grass grow. You know, it takes forever, and that's a good thing. What will happen is you know, by waiting and waiting and waiting for these weekly charts to come to fruition, you learn patience, and you don't learn that trading the 3-minute charts. You don't learn that trading the 15-minute charts. You don't learn the patience. You may feel like you're being patient when you trade the other time frames, but it's nothing like waiting for a weekly chart to come good, right? Now, I'd like to give you, do they provide a higher hit rate? Alexander, that's a good question. I don't necessarily want to say that. I think it depends on the trader. So I don't necessarily want to say that. What I found in general, though, in my testing and in my trading, the higher you go, the higher win rate. The lower you go, so in essence, what I'm saying, Alexander, and it's a great question, thank you, is that the lower time frames can give you higher reward to risk if you're paid, you know, if you trade the right way, but you get more losers. The higher time frames might have less reward to risk, but a higher win rate. Now that's just in general, so you need to test on your own before you decide if that's the case for you, but that's what I found. Okay, so here's another thing that we should definitely talk about when we get into weekly charts. And somebody give me your birthday. You don't have to give me the year, just give me the date. We'll use your birthday as an example. I've never done this before, and I think it's a good idea, actually. Surprised I didn't think about it before. So, for example, your birthday might be January 7th or something like that. Just type in your birthday there, and we'll use... Kevin says, do you look at the monthly chart? We're going to use an example here. Just type in your birthday, like, you know, August 17th or whatever, and then I'll pick someone at random. Do you apply the higher time frame correlation by looking at the monthly chart? You can do that. You can do that. But I have to admit, I generally end up, like if you're trading the weekly chart, definitely use the monthly chart to find your zones. But I have to admit that I tend to focus on the weekly charts. It's hard for me to say, you know, in the next 6 to 12 months, I expect this to happen. You know what I mean? I'm better at weeks. Maybe that's just my bias, but I think you certainly could look and get a bias from the monthly charts. No problem. Okay, so I hope that helps. Okay, yeah. Well, we have a couple of people here born in December, November, January. Okay, interesting. All right, well, let's use January 13th. So we use the week of January 13th, which happens to be, where is it? Find it right here. 8762. Oh, these are months. Sorry. Forgot that I was on months. Whoops. So I'm going to go back to January 13th, and we'll use yours. That is Carlos. Thanks, Carlos, for sending through your birthday. It's right here, January 13th. Okay. Okay, so it's this week right here. All right. So let's focus in on the daily chart in this is 1999. So I know it was a while ago, but this was the week of your birthday, the week of January 10th, 1999. Now I'm going to back it up, go all the way back to 99, and what we're going to do is we're going to look and see what happened during this week. All right. So what we have here is we've flagged that's the wrong one. I didn't go far enough. Here it is. Here it is. Now we're talking. And actually, this is the perfect example. This is a very, very common pattern, guys. I want to show you this because if you think about trading the weekly charts, you need to know this. So here, this is Friday, January 8th, right here, this little red candle. Let me zoom in so it's easier to see. Okay. This candle right here is Friday. Okay. This candle right here is Monday. Friday the 8th, Monday the 11th. Tuesday the 12th, Wednesday the 13th. Happy birthday, Carlos. And then 14th, Thursday, and Friday the 15th. And then we're back to Monday the 18th, okay? Now, this is what we see. I want to mark this candle right here. This is a really bad candle to get in on a trade. It's the Monday candle, and you'll also notice that this candle gave us what? It gave us the low of the week. The weekly candle low was made right here on Monday. So this little dip down, that was the wick of the week, right? Because actually the wick of the week was the whole Monday candle if you think about it. Because look, the opening price of the week was right here, where this Monday candle opened. Actually, let me make this a different color so you can see my candle. I know it probably is difficult to see. This is really, really important, guys, that this candle opened at this price. It closed down here on Monday. It actually went as low as this. But from this open to this low is actually the wick of the weekly candle. The wick of the weekly candle was made on Monday. Now, in this case, Thursday also gave us the high of the weekly candle. That's not always the case. Sometimes it actually is Friday, and you see a pullback on Friday. This week we didn't get that. It is a little less common than what happens on Monday, but you often do see a bit of a pullback on Fridays. Now, what's interesting is that Monday was a down day. So if you were trading any sort of a breakout, sell trade, whatever, the market had been going down for a while. And if you took a sell based on what Monday did, you were blasted because it went up the rest of the week. And I want you to pay attention to that. So what that means is if I'm trading the weekly candles, I don't want to get in on Mondays. That's a terrible day to get into a weekly chart trade. I want to get in here on Tuesday, Wednesday, and Thursday. Just like when I trade the daily charts, I want to take my daily chart trades. Like today, I'll talk about the trade that I took today, just a few hours ago, in fact, was triggered. So, and the reason why I like this trade is because it's happened today, which happens to be a Wednesday, and it's not a Monday. Wednesdays are great days for trades, so Monday's not. So everyone understand that? If you go back in the charts, what you'll see is Fridays often make one end of the week's wick. I know it didn't happen here again. I know the wick was made, Thursday, and then it closed like there on Friday. So it did pull back a little bit from the high on Thursday to the close on Friday. But normally you'll see a little bit of a wick made on Friday, and definitely Mondays will make a wick as well. So Mondays are not the day to follow the crowd, right? Let the crowd all get in early, and you can wait until Tuesday. So if I had any sort of an order on my weekly candle, I would definitely let it ride Monday, let Monday establish a new low or a new high, and then put my order in. All right, so hopefully that makes sense. Milan says his birthday is today. That's pretty funny. That's pretty funny. Are there any questions about that? That makes sense, right? The idea is that there's no real reason to get in when the market's going to make a wick. You want to get in when the market's making the body of the candle. That's where the meat is, right? Sort of like being a trend follower. When you're a trend follower, you don't take the bottom, you don't buy at the bottom of the trend and get out at the top of the trend. You buy somewhere in the middle and you get out somewhere in the middle. And you leave those edges to the bottom feeders. You're a trend follower, right? Trend follower would get in maybe somewhere around here in this trend after it cleared these highs or something like that. And then it went up here and then it pulled back like that. And then the trend follower maybe gets out somewhere in here. So the bulk of the move, if you look from the low to the high, the move was 2,684 pips, but the trend follower only made 1,033 pips. So, and that's pretty typical. Same thing when we're trading the weekly charts. We want to let the other people fight over the low and the high and try and get in the perfect position, and we want to get in at the meat of the week. Yeah. All right, so we know that the institutions watch weekly charts. We know that you're probably not going to take a full loss. You will reduce your average loser, therefore. And we know Tuesday, Wednesday, and Thursday are trade entry days. Tuesday, Wednesday, and Thursday. Monday and Fridays are not good days. Let the market settle. And it's just like trading the daily charts. I like to get in on these days in the middle of the week. The days out on the edges of the week are often pretty poor days to get into a trade. You'll miss out on some good ones, but you will save yourself a lot of heartache just by doing that. All right, another thing that helps by trading the weekly charts is we learn patience, which is absolutely critical. One of the biggest problems we have as traders is we feel like we have to do something. We feel like we have to be doing something, or you're not trading, you're not making any money, you're not doing anything. Well, I'm sure that if you've looked at your numbers, you've probably realized something that's very common among traders, which is if you are always sort of trying to, do something and always looking for more opportunities, you end up taking too many trades, and some of them are subpar and they're not that good, and they end up being losers. So you can churn a lot of money in your account just by taking too many trades. Instead of waiting for really good weekly setups, that can really help you because why? Well, because that means that you might be able to actually find a higher win rate and less stress. The other thing that happens when you're trading your weekly charts is you pay less commissions. Pay less commissions. So if you're paying a 2-pip spread on a trade that has a 500 pip stop loss, right? Well, 2-pip spread on 500, that's a really, really low percentage of your overall risk is paid in commissions. If you're paying a 2-pip spread and you've got a 10-pip stop loss, or you can reverse it and look at it from profit target. If I'm paying 2 pips and I got 500 pip profit target, or if I'm paying 2 pips and I got a 10 pip profit target, I'm paying 20% of my profits in commissions, right? By paying 2 pips. But if I've got 2 pips and I'm getting 500 pips reward, I'm only paying 4%, right? So it's one of those things where, you can really, if you think about it, you can make it easier on yourself to get over the hump just by not paying all those commissions. And you do pay more commissions if you are trading for smaller profits, for smaller pip profits. There's no way around it, right? Another thing that a lot of people aren't aware of is the fact that when you trade with your you're not using your lizard brain. So when you're trading and scalping and getting in and out really quickly, that activates the same part of your brain that deals with gambling, sex, rock and roll, and drugs. Okay, maybe not the rock and roll part, but all the rest of that. And that's the lizard brain, right? If you've ever seen someone who's brain damaged, if they're brain damaged in the frontal lobes, they have they can't stop their impulses. They just say things that are crazy, and you would think that's just really rude, and I can't believe you said that, but that's because they're not using the frontal lobes to repress things that you want to say and you want to do, but we don't do. That's most of what our brains do, right? They stop us from murdering and doing rude things to people. Well, when you're scalping, when you're trading the lower time frames, you are using your lizard brain, and you're not planning and executing a long-term plan. Guess what happens when you trade the daily or the weekly charts? You are using your frontal lobes, and you are planning. You're doing something very different. It's extremely different to going ahead and taking a lower time frame chart trade. So it's a big deal, guys. So I just wanted to show you. Joe says, how about managing the target? It's based on weekly or daily chart. We may give back significant profits while exiting. I'm not sure about that. I don't know. That's an interesting thought. I actually think that you end up waiting longer for it. Like, think about this. Let's say that you got in on this pullback here. I didn't, because it wasn't a true kangaroo tail. It was the close was not inside the previous candle's range, so it wasn't a kangaroo tail. But if you're waiting for this zone up here, and you've been in profit every single week. And so if I wait for it to go all the way up here, I'm making 1,257 pips on this kangaroo tail, and I have roughly a risk of, 280 pips, 290 pips on that trade, and I'm going for 1,200. So it's like 6-1, isn't it? So if I wait for this target and it is hit, I think that you're not necessarily giving back the profits. Now, to your point, I agree. If it were to pull back here, like let's say at this stage I move the stop loss to right here. So if it were to pull back here, you're right. I mean, it could definitely, you're going to lose. You're only going to make 460 pips if you ratchet up your stop. If you're using the 3-bar exit, you would have your stop down here too. And then depending on what this week does, you'd probably end up having your stop loss here next week. So it is possible, but I think it's more, it's encourages you to wait longer, trading the higher time frames like the weekly, and I think it helps foster patience, which is, I mean, when it comes down to it, traders are in one of two camps. They trade too often and are very impulsive, and that's encouraged by trading the lower time frames and using your lizard brain and not really, restricting yourself with your frontal lobes. Or traders are scared to pull the trigger to do something. And most traders are in the first camp. Most traders overtrade, are always looking to trade, and they're not those traders who, it's quite rare to find a trader who can't pull the trigger. Now, that's why I think, again, learning patience and enabling yourself to having a plan and allowing yourself to actually wait slowly for the trade to unfold, I think is a better thing for most people, even if you do end up going back down and trading the 1-hour charts. That experience trading the weekly charts can really help. It also can just add to your portfolio. You can have, even if you follow 20 currency pairs and you're trading the weekly charts, you might only get another 6 or 7 trades over the year on those 20 currency pairs. You might get 20. You might get about one for every pair for every year. But what that means is that's 20 trades that you didn't have before. And if at the end of the year you look back and go, wow, I took 20 trades on the weekly charts and I had an 81% win rate and I made $2.7 for every dollar I risked, whereas, on my 15-minute charts, I had a 61% win rate, and I made $1 for every dollar I risked or whatever. You might end up, it might make sense for you to stick with those weekly setups and maybe, pare down some of the lower time frame charts. And what you could do then is look for more markets. That's something that happens too. When people learn that this works so well for them, they end up expanding their horizons, trading CFDs or whatever. That could be another way to go. So it's just something to keep in mind. Okay? All right, guys. Let's jump into the charts. I can show you the trade that I've got, which is this one right here. Actually, yeah, this is it. I mean, I was going to show you a different chart because it's got all my numbers on there. Actually, I will show you a different chart. If you have any questions, pop them in the window. I'm going to go over, and actually any pairs that you'd like to see, I'm happy to take a look at those. I'm just going to pull over my other chart here that I like to use for my charting and show you the Aussie dollar trade. There's a couple of different ways to look at it from a naked perspective. It may be like a busted kangaroo tail, or it's also a possible Acapulco trade. It's a simple breakout. Lots of different ways to look at it. My stop loss in this trade is at 86.39. I sold a few hours ago when the market made touched my entry order at 85.07. Now remember I was talking about how Mondays are bad days for weekly chart trades. Well, Asian sessions are bad for daily chart trades. And if you look at the 1 hour chart today, what you'll see is the Aussie dollar mostly went up. So here you are, first candle of the day. Here's the Asian session right here, all the way to here. And you can see when Germany fires up and London went up a bit, spiked up, took out the high here from the Asian session, and then fell like a brick. So now my order was below this low, yesterday's low, which is the lowest low on the chart. If it made a lower low during the Asian session, I would have placed my order 5 pips below that low, but it didn't. So the order remained right here. And so I've got targets on this setup of 83.90, which is 100 pips away from where we are right now, and 82.70 down there, which is another 120 pips away. So 240 pips on that one. So that's the trade that I've got on right now. Do you guys have any charts that you want to see? EuroCAD. Okay, cool. So that's the one that I'm in right now. And if you follow my trades, you would have seen the videos on those. One during the Asian session and one during the London session. The EuroCAD. Yeah. We've been talking about this one actually in our group. So this is interesting. I mean, it technically it's a possible last kiss, but I will say that most last kisses don't look like this. This to me looks like a false breakout. It's not confirmed yet as a false breakout because we haven't closed back in the box. But if we do close back in the box, this is a false breakout, and we'd have to wait for another breakout. It fell like a brick last week, and since then it's come back up and touched the box. Now, what's interesting about this breakout is that every candle since the breakout has actually touched the box, the edge of the box, which is rare for a last kiss. That doesn't usually happen. So the breakout candle obviously touched the edge of the box right here. The Monday's candle touched the edge of the box with a high. Yesterday's candle also wicked into the box, and today we're actually in the box now, but we haven't closed in the box because we've got a ways to go in terms of the daily candle. So maybe we won't see the market actually close in the box. It may fall still, so still could come good. But the point I'm trying to make here is that normally a last kiss would go away from the box and not remain on it, touching it. It would come down here and mess around in here and then come back up and touch over here. So this is a very close move back to the box. And usually when these sorts of things happen, like over here, it goes right back in the box like it did over here on this false breakout. So just something to consider. The other way to manage this would be on a weekly Acapulco. So that would be expecting it to get up here and tag the edge of the box here and then possibly pull back a bit. And then next week or the following week, we would actually see it make a new low and fall down to here. But again, that assumes that we stay below this edge of the box here, which is where the market is right now, right on top of that edge of the box. So that's pretty critical what it does this week. The pound, says Alexander. Yes, definitely. Yeah, I mean, this is a real mess. Here's the thing. It looks like I'm actually in a trade, but I've got my stop loss at plus 4 pips here, and it's probably going to get tagged. It's come close. It's come within 15 pips of it, but it hasn't tagged it just yet. This is what it looks like, Alexander. This is a really common move where when the market's trending, it will do these little retracement moves. See how all these candles are like, you got red and you got 2 green, then a red, 2 green, and then another, I don't know what today is, maybe it's a red, but see how they're kind of all jumbled together and they're not really going anywhere, they're all in the same spot? That's kind of what you get during retracement phase. So this looks like a retracement phase, and it's just gearing up to make another huge red candle down. So if I were trading the pound, and like I said, I am in a trade right now, and I fully expect it to get stopped out at break even, but there's a slim possibility that I can withstand that, and I can actually see the market fall all the way down to 55.70 or even 54.60 down there, which are my targets. So this is behaving much like a retracement during a downtrend. So I fully expect to see a big red candle pop up soon. DV, I think we talked about the Aussie, right? That's the trade that I'm in. So yeah, we talked about that one, right? No worries, Alexander. Yeah, so I'm in this trade. I sold at 85.07. I'm targeting 83.90 and 82.70. My stop loss is at 86.39. So this is a busted kangaroo tail here. So definitely in the Aussie trade. Yep. Cool. Any other questions, guys? Anyone? No worries, no worries. Euro pound, says Alexander. Sure. Euro pound. Yeah, this one's interesting. We might actually, I was waiting for a touch up there that never occurred. We were hoping it would get up there. This one is in consolidation, obviously. You can see here in the box. If you draw a massive box, you can see that we're doing something like this. So you could wait for a last kiss, bounce and go higher, or a last kiss, bounce and then go lower. If I were looking at the weekly, I would probably notice that we had some sort of weird giant bullish candle 2 weeks ago, but then last week it tagged a significant level here. Wow, this could really go either way. I mean, you could make an argument that we're at a double bottom, but I think it would have been better had this second bottom here, had it gone lower and come closer to the first touch, because that would have really validated this as a support level down here, this 77.60 level. It didn't do that, and that's kind of a bad sign. It either means that the market's gearing up and really ready to go higher, or
it means it's going to come back down and test it again, which would be a bad sign because that might mean that it'll break through and fall lower if it does make up the third touch. So it's really in a holding pattern. I don't really know what to say about this other than I'd wait for it to break out of the box to learn more. Yeah. Yeah, very choppy, very choppy. Agreed. Agreed, Deviant. Really, really choppy. Any other charts that you'd like to see before we shut it down, guys? Oh, I will mention that gold still hasn't printed a bearish candle here, and silver is up at a level that I expected to see some resistance and perhaps a sell signal, but we don't have it just yet. I'd love for silver to give us a nice kangaroo toe or something right here because it's there. It's on the level. Two parts to naked trading. One, you wait for the market to get to a level, historical support and resistance level, and two, you wait for the pattern to print. So we're waiting for the pattern to print on silver and gold. The Swissy, yeah, Swissy did a really nice belt the other day. It looks like it's going to pull back though. So if you're looking at this and you go, wow, Swissy came here, 97.37, printed a belt. It's fallen, but if you look at the lower time frames, I actually think it's going to try and make it might double top up here. So you have this 4-hour belt and the market really fell and so forth. But, given this big bullish candle here, I actually think it's in the midst of an upturn. But I don't really have any strong opinions that are going to, say, I'm going to buy it here or something like that. I wouldn't buy it here. Definitely wouldn't buy it here. If anything, I'd wait for it to get back up here and see if there's a good sell. But yeah, definitely wouldn't buy it. No worries. Aussie Kiwi, says Linda. Great choice, Linda. So, remember the Aussie? We were talking about how the Aussie had broken through a significant level and busted a kangaroo tail. Well, here is your significant level right here. 109.26. Lows, bounce. Looked like a bounce and then broke through. Couple of different ways to do this. The first would be to wait for a 4-hour candle to come back up here, touch the 109.26 level, and fail like a bearish candle or something up here. Another way to do it would be, another way to do it, and this would be kind of tricky, is wait for an inside candle to print over the next couple of days and then put your sell order below the low of the big mother candle. You know what I mean? So if we get a few moves down here and then we get a little inside candle, that would be a pause, an opportunity to actually get in and sell there and put your stop loss above the high and just let it ride. That would be another one. So, yeah. Or you could just back it up, go to the weekly and trade it as a weekly Acapulco and see if next week's, assuming that this week is a bearish candle like it is right now, see if next week's candle wicks up into the 109.26 area, and that would be an excellent setup for that. So lots of ways to trade it. 4-hour, weekly, lots of different ways to trade it. Yep. Cool. All right, guys. Thanks, Linda. Thanks, Joe. See you, Adinda. Thanks so much for your time. Thanks, Alexander. We'll see you, Carlos. Bye, Chi. See you, Daniel. See you, Gabriel. Bye, Galen. Take care, guys. Have a good one. Thanks a lot, Kevin. See ya. Take care. Bye, Sue. Bye, Sandy. Bye, Ray. See you, Pep. Take care, guys. Bye.